All right. Hey, everybody. My name's Tim Hart, Van Dyke Mortgage. Appreciate y'all being with us today. We're pretty excited about this. We got two special guests with us from Florida Housing. We got Charles and Sandy. They are two pros, and we are going to be going over the Hometown Heroes changes that just happened. And first off, just so you're aware, is you may have been invited by one of our loan officers at Van Dyke Mortgage. We welcome you. Appreciate you being here today. This is a learning event for y'all. We believe there's some huge changes that are happening that's going to help your business out. Hometown Heroes was great before. It's even better now. All right. And you are going to be able to take the knowledge you're going to learn today and you'll be able to help out a lot of new clients out there that are renting and help them own a new home. So we're pumped for y'all to be here. A couple quick rules. We do have everyone on mute, so it doesn't turn into a melee here. So if you need to have questions or anything like that, we're going to be monitoring the chat. Use that. Chip and Sandy will be happy to take questions throughout this. So I'm going to be handing it off to them and just letting them run with it. So Chip and Sandy, are you guys ready?
I think so, Tim.
All right, buddy. Well, hey, the show is yours and off to the races, man. So have at it.
All right. Hey, everyone. Thanks for being with us here today. We're going to talk about the upcoming changes or enhancements, we like to say, to the existing Hometown Heroes program. I'm Chip White. I'm the Home Buyer Programs Director here at Florida Housing, and I have Sandy Smith on to help me also. She'll add color throughout and also help answer questions as they come along. If you see the screen here, this all takes place starting July 3rd. I know everything you saw says July 1st, but that's a Saturday. And as much as I love my job, I will not be working July 1st. But we will be open July 3rd, even though it's the day before the 4th of July. And we expect a lot of activity that very first day because we have lenders and realtors who've been working this program really for about a month and a half now, ever since it was signed into law. So we're going to talk about what's changing, what's staying the same. If you've worked with the program, I think you're going to like what you hear. If you haven't worked with the program, you need to get busy because this is going to be the big product for the next 4 to 5 months. Next screen, next slide. Okay, so what's changing? So this whole enhancement came through the Live Local Act that was signed by the governor on March 29th, I believe, when it was actually signed. It started as Senate Bill 102 in the Senate. Senator Kathleen Passidomo, who became the Speaker of the House this session, affordable housing was one of her big priorities. And so when she came into power, it was the Live Local Act that she sponsored. And actually, it was passed, and that's where this extra $100 million is coming from. It's coming from that act, which actually put about $711 million into affordable housing. So again, it's a huge amount of money. The first program we ran for a year, really. It took us to spend the first $100 million. And I don't think we actually have any numbers in this presentation, but I did something yesterday with Mortgage Bankers Association. Basically, it generated about 6,800 loans, helping over 14,000 individuals become first-time home buyers in the state of Florida. And it generated over $2 billion of first mortgages. So that's a whole lot of real estate that was sold in the last 12 months. Let's go to the next slide. This is just some of the fluff, if you will. We can skip this slide. Let's go to the next one.
Yeah, let's skip it, man. No fluff here, Chuck. My granddad's name was Charles. We always messed with him and called him Chuck.
Oh,
all right, Chip.
We'll get in trouble.
Oh boy.
Okay, so here's the big change, guys. This is what everybody wanted to hear about. Is when we got the first batch of money, we were kind of restricted in who we could help. The first round, basically, they gave us about 50 occupations to work with, and they were all frontline workers, deserving borrowers, of course. You know, the firefighters, the nurses, the teachers, you know, all those folks, veterans, military. We actually dug through all the statutes that define those first 50. And we actually were expanded about, what was it, Sandy, about 100, 105 when you got through doing the chart?
Yep.
Okay. But unfortunately, there were a lot of people, a lot of deserving people who were left out. An example was, you know, in the hospital, we wound up helping a lot of nurses, a lot of CNAs, again, which was fabulous. But then when it came to people like sonographers and surgical techs and other people, they were not specifically defined, so we couldn't help. That's no longer going to be the case because the occupational requirement is going away with this new batch of funds. It just means you do not have to have a specific occupation, okay? So what we're going to do is kind of go through, what they do have to have. How do they qualify in the enhanced Hometown Heroes? We're calling it 2.0 just to distinguish it, but it's still just Hometown Heroes, okay? Next slide, please.
Yep, and just before I keep going, I know there's, we had one in the chat. You see Tim, but no charts. Sorry, you gotta look at me. I apologize. But you should be able to change your settings up in the top right, the way you view the speaker view, gallery view. That should help you out. All right, Chip, there you go.
Okay, thanks. Okay, so we've gone from occupational now to basically they've got to be employed in Florida, working for a Florida-based company. And there's been a lot of confusion about that. So I want to be very clear about this, and we'll spend a minute or two on this. It just means they're working in a brick and mortar location in the state of Florida, okay? They go to an office, or they're tied to an office in the case of, let's say, a remote worker, but you can tie them to a business that's in the state of Florida. This isn't the California Hometown Heroes or the Michigan Hometown Heroes. It's the Florida Hometown Heroes. And the legislation was written such that they said, really, everybody that works in Florida, Florida citizens should be able to buy a house, and live in the community that they basically work in. And that was a basis for expanding, and getting rid of the occupational requirement. But again,
Chip, I have a question.
okay.
What if you have a borrower that, say, let's work for Walmart, but the corporate office is located in Arkansas? Would that borrower qualify?
They sure can, Sandy, as long as they're working at Walmart out on Thomasville Road, north of town here. That is a location here in Florida. And that's a great question, Sandy, because that really clarifies what we're looking at is you could track them to a business here in the state. And the other requirement, and this is a requirement, this is now law. The first round of money was done under proviso language, so we had some wiggle room about kind of how we interpreted things. But this is now a law, so we have to be very specific. And that buyer working at that Florida-based business must work a minimum of 35 hours or more a week, which lenders will have to actually verify that. And whether it's from a pay stub, from the HR department, CPA accountant, however they can document 35 hours or more a week, that is a specific requirement. And Sandy, before you ask the question, the one we always use is, we did a lot of travel nurses in Hometown Heroes 1.0. We found that a lot of travel nurses work 32 hours a week. They're very well compensated. So we kind of determined that's all they had to work. But the employer could say they were full-time, which they would consider that full-time, but that person would no longer qualify for this program, okay? Because they only work 32 hours, even though they're still in the old program of qualified occupation. All we had to say in the old program had to be full-time. This time is 35 hours or more per week. So very specific.
Hey, Chip, I have another question.
I was going to say, anything to add to that, Sandy?
Yeah, what if they had 2 part-time jobs that equal 35 hours or more? Would they qualify, or do they have to have one job that has 35 hours or more?
As long as 2 jobs with Florida-based business, you can add the 2 together and they qualify. And building on that too, Sandy, this is a very confusing sometimes to some people. Only one borrower has to be a hero, not both of them. We got that a lot on the old program. Do both people have to be in that occupation? No, only one. And it's the same with this. So you could have, borrower 1 working at Walmart 35 hours a week. Borrower 2, heck, could be retired. They could be working remotely for a company out of California. That second borrower doesn't matter. We just really, only one has to qualify. Right, Sandy?
Absolutely.
Hey, Chip, can I jump in for a second on that?
If you must. Yes,
Thank you. I appreciate that. I wanted to make sure that everyone, the realtors watching this, because you guys are getting like part-time income. Remember, there's FHA, you have VA, you have conventional. These are all Hometown Heroes. You can do all those on those loan types. There could be restrictions on part-time income. They may not have had it long enough. So just keep that in mind. Usually looking for a 2-year history of part-time income. So just kind of keep that one in mind. And we do have a couple of questions. Can I hit you with these, Chip and Sandy?
Go ahead.
All right, Greg asked, what about a business owner, let's say a roofing company, and their office address is their residence?
As long as we can look them up, or you can look them up in SunBiz, DBPR, they're a licensed Florida company, that's fine. That's what That's what we're going to compliance to, Tim, is we're going to look
Yep.
at your 1003. And is that the business address, and is it a Florida-based business? So you're verifying that on your end, and then we'll compliance that when the file comes in.
And this will also be very similar, correct me if I'm wrong, for people that like, I work remote, I'm a salesperson, I have a route down here in Southwest Florida. And I work out of my house, but my company's based in North Dakota.
Again, as long as he's established himself as a business, and we could look up that business.
Yep.
Yeah, what doesn't qualify, and we had this already questioned the other day, would be there's someone that they're in New York right now, they work for GE, they work remotely, they wanted to move to Florida. We've got GE offices in Florida, but he was going to be working remotely still for the New York office. They would not qualify. So there's, and again, this is what our lenders are good at, folks. They're really good at getting down in the trenches, in the weeds. This is what they do, so you don't have to do. Because what Tim does is he calls me and Sandy if there's ever any doubt, and we figure out a way through it, right, Sandy?
Yeah, way too much. And on that point, Chip, just remind realtors, never deny a buyer. All right, let your lender, let the loan officer, let them make the decision for you on that.
And we have other products I was going to add too, Tim. I mean, HomeTown Heroes is not our only product. We have bond loans, we have other TBA loans. Tim has other products, in his arsenal of weapons of loans that he could look at. So again, that's a great, great thing to say, Tim. There's all kinds of ways to help these folks. This is just one way.
Hey, Chip.
Yeah.
I was hoping we could expand just on self-employed borrowers for just a second. I think there's actually a place in the presentation, but go ahead and address it since people are asking. There are two types of self-employed borrowers, right? Your 1099 and your Schedule C. If you have a contract with a company, as long as that company is in Florida, or you as a 1099 employee have your own business, then you would qualify. If you're Schedule C, that gets a little more challenging in trying to qualify them with the hours. But you should, as a self-employed borrower, be able to validate that you have a business and you're in Florida. But if they're self-employed, they would need to have, like, say, if they're contracted, have that contracted employee say, confirm they work 35 hours or more, or even their CPA can do it. And we know that's an unusual request for a self-employed borrower, because usually we're just concerned about income. We don't look at the hours, but self-employed borrowers are still required to validate their 35 hours or more. So just keep that in mind. And there's a question about USDA. We allow RD, but you would just need to talk to your lender about if they qualify also for RD and with HomeTown Heroes. And as Tim said, there may be other income requirements outside of what we're asking. Just make sure that you check with your lender so they can, like he said, if somebody hasn't been employed for 2 years, they can't use that income. So just talk to them. They're the experts. USSA is headquartered out of state.
And Sandy, you were hitting those. There was one question above it. It said, what if the borrowers are retired?
Nope. Sorry.
No, they have to be working unless they're veterans. And just to clarify on veterans, we get this all the time, is does the veteran have to be employed and work for a Florida-based business? No, veterans are sort of expected to be retired. That would be the assumption. So they would qualify just by providing a DD 214. And to address the question about USAA is headquartered out of state, but there's a brick and mortar in Tampa, then they would be eligible as long as you can validate that they have a brick and mortar location in Florida. We've said this is,
and they work out of that location.
This is for the lender to help you guys with.
But Sandy, as long as they work out of that Tampa location would be the key. Okay.
Right.
Killing it. Keep going.
All right, let's go next slide.
Sorry, Chip.
No, that was good. The self-employed.
You took one job away. All you had to do here was read the questions. You're doing it all. So you get it done, girl.
So this is a new form. In the old program, we had an attestation form where the borrowers would sign attesting to certain facts that made them program eligible. This is kind of the same thing in this form. It's a borrower certification, and it's signed by anyone that's going to be on the application. Whether they're the hero or not, we want all borrowers to sign this certification. It basically says I'm a full-time Florida resident and employed by a Florida-based employer, 35 hours more a week. Said the house they're buying is primary because that's all we do. They can't purchase a vacation home in Florida with our money. And then it tells you what a first-time home buyer is and tells you, I am a first-time home buyer. There's some language in the middle there. We're saying there's really no cost to apply for this program. Now, lenders may charge like an application fee or anything, but we're really saying you can't charge anything that's outside of anything that's been going to be disclosed or has been disclosed. Someone can't ask for, let's say a mortgage broker, for instance, might say, I don't make much on this, so you need to pay me $4,000 off the books. That obviously is not allowed. So that's what this language is all about. And I've got to point out the sentence at the very bottom, okay? Because this came up in the last program. Now, borrowers are going to certify they've not been convicted of a sex offense against a minor. Terms are defined in U.S. code. And if you're interested, you can look up the code. It describes different levels of sexual predators that this actually covers. We're not looking for this. It's nothing we compliance to. But if it ever came out and somebody, blasted all over Facebook that we gave money to somebody that was convicted of this, and how are they a hero? And this may have happened once in the 16 years I've been here. We were told to include this language. And again, so I don't want to hide it from you. I want you to know it's there. Again, I doubt it will impact any of the transactions you're involved in. But again, it's in the certification. So I need to make you aware of it. Okay.
And also, Chip, if I can just add, so the realtors on this call know, background check is not one of the parts of the mortgage process.
Right.
So
right.
We're not, it's hard enough as it is, right? We don't want to add a background check to it.
Exactly.
And Chip, I just wanted to add too, that when we talk about no additional cost other than what's the program cost, and of course the standard origination fees that your lender charges, I just want to say, not to toot Van Dyke's horn, but they've been with us for a very long time, and they're such a strong supporter of our program, and their fees are in line. They don't charge excessive fees or anything. So you need to make sure that you're working with a lender like Van Dyke, and have the lender talk with the borrower about the certification. I don't know that you guys need to dig too deep into that, because it is awkward.
Yeah, let the lender do the heavy lifting.
Yeah,
Let Tim and his crew do the heavy lifting, I always say. They'll sell the real estate, they'll close the loan for you. Okay. Let's go next slide, Tim. Okay, we kind of hit on this with Sandy just a while ago, so I don't think we need to spend a lot of time on this. Whenever you have a question, reach out to your lender. And if it's a situation, we've got a lot of nuances in these programs and gray areas, and we'll talk it out and figure out, really what we need to look at, to compliance to. So just, leave that to your lender. Since we've hit this already, let's go to the next slide. Okay, so what's changing about the DPA? So, in this first round, we basically provided up to 5% of the loan amount, capped at $25,000. And I'm going to jump ahead here, since we use conforming loan limits, which basically on a conventional loan goes over $700,000 now, and we are starting to do a lot of loans in South Florida, Central and South Florida, which are our main areas. They actually decided to raise that 25 to a cap of 35. Okay. And that doesn't mean you get 35,000. It means if you do you sell a $750,000 house and it's a $700,000 loan, 5% of that, they get the full 35,000. If it's 500,000, then they're going to get $25,000. So it's a cap. It's not the amount that we actually put out there on the table. Something we did find in the first program that we think we fixed here, believe it or not, folks, occasionally people find a house for less than $200,000, particularly true in North Florida where we are. So we were seeing someone that bought a $150,000 house, condo, whatever it might have been, would only get $7,500, since that's 5%. So what we did, we plugged it with a minimum of $10,000, which is kind of what our amount would be in a bond loan. We give a $10,000 of assistance. So we just didn't want someone to get less than what they would normally get just because they use this program, which generally has a much better interest rate. We didn't want to penalize them. Okay.
Hey, Chip, also, I've been asked a lot, if the loan is under $200,000, they can't do it. I don't know why. I guess they think the minimum DPA wouldn't be $10,000. They can't participate. But just to touch on that again, we're raising that limit to $10,000 if they were going to get less, just to make sure that that lower income or that lower loan amount would receive sufficient subsidy to help with closing costs and down payment. Sorry, Chip.
No,
And,
that's-
and just to make sure everyone knows, we don't have that $200,000 minimum loan amount.
right. I was going to add that, Tim.
Yeah.
We do not have a minimum loan amount. You know, it could, I don't know what it would be, but it could be 50,000, 20, that's ridiculous numbers, but we do not have a minimum loan amount. We do have a maximum, and those are conforming limits. So let's go to the next one. Next slide. Okay. Now, this is something new, and I'm not going to sit here and read this to you, okay? But basically, in fact, all of the Hometown Hero loans in this last round were what we call TBA loans. It's a TBA execution. TBA stands for to be announced, as silly as that sounds. All that means is it's like a traditional loan that our lenders do every day. They look at the 1003 credit qualifying income, all the standard things they look at in a normal loan. And it means we get a daily rate sheet just like they do. In these crazy times, we may get 2, even 3 rate sheets someday. So it mirrors what our lenders do, and that's called a TBA loan. A lot less restrictive than a bond loan. However, with these rising interest rates, we found that our bond program has been offering a lower interest rate sometimes than even our very low TBA rates for Hometown Heroes. So finance basically said, hey, why don't we also offer a bond alternative, when it might be a better execution than a TBA loan. Keep in mind, bond is a much more restrictive. Basically, you use household income. Everyone in the household income counts towards qualifying. They got lower limits. I can go on, and I'm not. And bottom line is, let your lender decide what's the best product. Okay, if they're bond eligible and it's a lower interest rate, they'll say, hey, if they're going to get the same 5%, so let's go bond and get 6% instead of 6.5% today for an FHA loan. So that's the only reason you would ever even look at considering and living up to the more restrictive standards of doing a bond originated first mortgage product. Okay. So that's.
Can I jump in there with you real quick?
Yeah.
I feel like we make a good trio, by the way, me, you, and Sandy. I think we're doing good, Chip. I think we're doing
good.
All right. I wanted to make sure that, and kind of pay attention to this, realtors, if you're out there listening, we're seeing Hometown Heroes conventional loans priced better than a normal 20% down conventional loan. So if you have a conventional buyer that's out looking right now and they're doing 20% down, the 740 credit score, but they're a first-time home buyer, this program will more than likely give them lower cost and better rates. So make sure if you have someone out looking around that you guys look into that. Because we saw one, I see Sean on the call, but I think it was about a point difference in rate. It was a massive difference. So make sure you're talking to your lender, talk to your loan officer or us. That's a big difference for y'all as borrowers, man. A point and way less in cost too.
And talk to Tim to quantify that. The current program is suspended because y'all spent all my money, Tim. But I still get a rate sheet every day. Today, my over 80%, which are higher income conventional borrowers, would be 6.5% with no points.
Yep. That's great because that's with no points, you guys. So that's going to be a big benefit to those first time home buyers that are putting money down conventional. I don't care if they're doing 30% down. Let them look into it.
Right. And again, I'm not going to teach y'all how to be, bond realtors today. So we'll give Tim a copy of this. Tim, if you want to, well, you've got it already. If you want to distribute it later, that's
Sure.
really up to you. Okay. So let's go on to the next slide. Let's talk about, okay. So we talked, before we leave that, I just one other thought from what you just said, Tim. There are no asset tests for this program. We're always asked that. Well, they're sitting on $500,000 in the bank. Can they still get this 25, 30, $30,000 DPA? Sure, they can. They keep their money in the bank, keep their powder dry. And what Tim was just describing, if it's a better interest rate, just because they have funds doesn't mean they have to use it. So I wanted to add that to that conversation, Tim. But what's staying the same is, remember, and I said this earlier, they're buying a primary residence and be a Florida resident. Let's stay here for just a second because we've got, hey, Sandy, I'm a veteran in California. I want to buy a house in Florida and move there, but it says I got to be a Florida resident. Can I use this program?
Yes, you can. because you will be a Florida resident when you purchase and occupy within 60 days.
Wow, I think I'm moving.
Hey, Chip, I have a question. Does a veteran have to be a first-time home buyer?
You know, I think we got a slide coming up about that. but-
Oh, do we?
Yeah, but no, we keep talking about veterans. Like, and you said this earlier, Sandy, veterans have the golden ticket. They don't have to be employed. They could be living off their benefits. They could shut the phone up real quick. Remind me to turn it up later, Sandy, or I won't answer the calls the rest of the day.
I will.
But yeah, so that DD 214, they're exempt from being a first-time home buyer. That means that they can own a house right now. The veteran I'm talking about that was in California, used the last program. They were going to keep that house and rent it out and have an investment property in California. They just didn't want to live there anymore because I think he told me because of the politics, but that's neither here nor there. But you can have another house as long as the house they're buying with our money is going to be a primary. And like Sandy said, occupy within 60 days. Active military, the same, is we've actually made them exempt as well. In a bond program, that's not necessarily the case. Only the veteran would be exempt. But again, most of these loans are going to be TBA, very few restrictions on them. But that's how we treat a veteran. Correct, Sandy?
Correct. But I also wanted to just kind of address the definition of a first-time home buyer. I think sometimes that gets a little confusing. They can't have owned and occupied their primary residence within the last 3 years. And ownership to us is defined as appearing on deed. So someone could have been on the mortgage, but not on the deed, and they still qualify as a first-time home buyer. And like 4-year veterans, they could live in their primary residence right now, have full ownership and move to Florida and participate. Also, other borrowers that haven't appeared on deed to their primary in the last 3 years can own investment property. They could be on deed to their parents' property and still qualify. So just know that there are more than one way to qualify as a first-time home buyer, and reach out to your lender so that they can determine that for you. My best advice is if you think somebody might be a first-time home buyer and you're not sure, send them to your lender so they can confirm that. Sorry, that was it.
Well, Sandy, what if I owned a house in Canada right now, but I don't like Canada. I want to move to Florida.
It's a good question. We get this all the time. Do you have to be a first-time home buyer and you could not have owned in the United States? It actually applies to anywhere. So if you're coming from Canada, if you're coming from Argentina, if you're coming from, Switzerland, wherever in the world you're moving to Florida. And of course you have a lot of people moving to Florida. They could not have owned in the last 3 years anywhere. So that does become fun for the lender to try to validate. But if you're doing the TBA program, that's a lot easier. But yeah, they can't have owned anywhere, not just the US or Florida. And I also wanted just to quickly address, Sean, is that you have a question about 2 to 4 year old properties, 2 to 4 units that are 5 years old. In the TBA program, we don't have a restriction on multi-units having to be 5 years old. That's actually a bond requirement. So if you're doing a bond program, then the multi-unit has to be 5 years old, but not in the TBA program, which is what you guys are doing. So hope that helped.
And your lender knows all this stuff. That's why I say leave it to them to lose sleep at night over all the little nuances. Okay.
And Chip and Sandy,
and I'm sure they never lose sleep at all. They never worry.
Yeah, we don't stare at the ceiling all night, all the time. I wanted to ask something with you guys because us being in the streets, we see and listen to this stuff. I want y'all to keep in mind there's a lot of people that live in Florida that lived in another state, the Northeast, Midwest, right? A lot of them in Florida. I want to make sure everyone's clear on what they're saying. They can have owned a home. They can still own a home wherever they came from, Indiana, Massachusetts, you name it, as long as they have not lived in it in the last 3 years.
Correct.
And so just keep that in mind. Okay. They can still own that home if there's a rental property, but they moved down here for 3 years, they can qualify as a first-time home buyer. So I want to make sure that one's come up a lot last few weeks.
Hey, Chip, can you, what if you owned a timeshare? Would that disqualify you?
Oh, good question.
No, and we get that from time to time.
All the time.
Timeshare is not considered residential property, residential ownership. It's just temporary ownership, 2 weeks a year,
Yeah, it's not primary.
For eternity, I hear from all the ads on the radio lately about how to get out of timeshare. But
Right.
anyway, but yes,
What-
and land is not considered ownership. Raw land is not considered ownership either.
Right.
So a lot of things aren't ownership. And again, check with your lender. They know the answers to these questions already.
Hey,
So-
Chip, just one more, because it's Florida. What if they owned a mobile home that wasn't deeded to land and they were leasing the land but had a mortgage on the mobile home? Would they be able to qualify?
They sure would, unless that mobile home is tied to the property as real property. Just owning a mobile home that's not attached to property, it's a chattel loan, it's not a mortgage, and they would still qualify as first-time home buyers. We get that a lot too. That's a great question, Sandy.
Great info.
Thank you.
Someone asked about the structure of the DPA. We've actually got a slide and we'll get to that in a few minutes, okay? Let's move on from this slide before it freezes here or something.
Hey, this is a good time, man. I'm having fun. You're doing good.
Well, we do this so much, we probably could just recite this, without actually going through the slides, but let's try to stay on track here. And so Sandy just hit this slide. You now know what a first-time home buyer really is, okay? The 3-year period. And the one thing we didn't hit on it was, we get this a lot, don't we, Sandy? I'm separated. I've been, or even, I'm divorced and someone still owns the home, but we separated 6 years ago and I've been renting an apartment, but I'm still on the deed to that house. Am I a first-time home buyer?
Well, if you didn't live in the property in which you appeared on deed, that you didn't occupy it as your primary residence for the last 3 years, then you would qualify. But that's
Being out
common-
six would be
question.
good.
Say that again?
Being out of the house for 6 years would satisfy that requirement?
Yes.
Okay.
If you were out of the marital home, and I get this a lot, I know you do, Chip, where someone just got divorced
Right.
and they weren't on deed to the property when they married. If they're still not on deed to the property when they divorce and they were not given any ownership interest in the divorce, then they would qualify. But again, reach out to your lender, because as my grandma used to say, there's more than one way to skin a cat. So
And that's true. I've met her grandma, but anyway, this is so you're seeing all these, like I said, these little nuances I keep calling them. This is stuff that we've got our new lender guide is what, Sandy, like 90 pages long that the
it's
lender
short.
have to sort through.
Short.
Um,
It's short.
Yeah, again, this is stuff for your lender. Just tell him what your situation is, let him dissect the situation, figure out which way is the best way to go. Okay. We always said, that the active duty military and the veterans are exempt. So are reservists. If they're currently reservists, they're also exempt. So we've got a really soft place in our heart for the military, and Florida is full of military. I think we've got about 1.3 million veterans in the state. In fact, that was the largest group that lenders helped with this last round of money. It was over 1,000 veterans, 1,000 VA loans. There are about 400 in active military. So that was a ton of loans. And this program is great for VA loan. Why? There's no origination points. There's limitations on fees on a VA loan. So we do a bunch of VA loans in this program. So if you're in an area of military bases or anything like that, or just, a lot of retirees are in the area, great people to go after, to try to help if they're interested in buying a home. Let's go next slide. Okay, so what are we're going to give you $35,000 when you have a $700,000 loan. Do we ever want it back, Sandy?
I'm sorry, I was technically, I couldn't figure out how to unmute for. Do we ever
Take a
want our
water
money
break.
back? Is that what you're asking me?
Yeah, I'm saying we just gave you a $35,000, 0% 30-year loan. Do I ever have to give that back to Florida Housing, or how does that work?
You do, and that's actually an excellent point, because we get asked about this a lot. And trust me, when a buyer calls after a period of time and they're like, I didn't know I had to repay this money, who do you think they say told them that it was forgiven? It's always the real estate agent. I'm just going to tell you, they throw y'all right under the bus, just like, and back it up over you.
Unless they're talking to the realtor, then they'll throw the lender under the bus.
I mean, you know how it works. I mean, honestly, you know how it works. But they usually say, the realtor didn't tell me. And I'm like, you should have read your docs. But anyway, Yes, it has to be repaid if they sell the property, if they refinance, even if they repay it after 30 years, it's not forgiven. A lot of people think it is. It's not. It needs to be repaid. Or if they don't occupy it as their primary residence. And these funds kind of go back into the pot and get recycled for future first-time home buyers.
And that's the key, Sandy. In the Live Local Act, they actually now call this program Hometown Heroes. Almost went with hardest hit, an old program. And they say they want it to be an evergreen program, which means a permanent program. Now, wouldn't that be nice to have this, in your back pocket year round and never running out of money? Well, for that to happen, this money's going to have to come back, and like Sandy said, back to the pot, and we will recycle it. And with interest rates being where they are, I don't, Tim maybe is better prognosticator than I am, but we don't see rates going down anytime in the near future. So we don't think we'll see a lot of refis. You're buying this house, at a pretty high market, tight market, unless you're going to move, your job moves. You're probably not going to sell it anytime soon and pay us back. So that they're going to have to keep feeding us money to keep this program viable and open. At some point, they want it to become self-sustaining, and that'll be from these repayments. So we'll give you 0% money, cheap money for a long time, but we always want it back to recycle and help more first-time home buyers, basically. So that's why it's structured this way, but there are no payments. Sandy, let's say I got a $20,000 DPA assistance from this, and I'm thinking I might want to move in 5 years, 6 years, 7 years. I don't want to be faced with that. Could I pay it off early? What can I do to make it go away? Sandy? Okay, Sandy's no longer.
I'm sorry. Did you know I was on mute?
Yes.
Yeah.
I'm sorry. The buyers can reach out to their servicer, and then they can set up if they want to make installment payments. They just would note that on with their mortgage payment, like I want so much to go to the second. They can even repay it in one lump sum. So, and a lot of borrowers, I would say a lot of our higher income borrowers that we're seeing in this program, as Chip mentioned, like loan amounts are what, 700,000. So you're seeing a lot of those higher income borrowers that have the funds to repay that post closing. So yes, that's definitely an option.
Yeah, you don't have to, but you can make partial payments, full payments, like Sandy said, and make it go away early, and then you don't worry about it. And we'll put it back in the pot and go help someone else. Thanks, Sandy. Let's go next slide.
Oh, hey, and Chip, just how we've been explaining this to people, that money is, we always compare it to like your rich uncle. Your rich uncle says, hey, here's 20 grand, pay me back when you sell it or refinance. Like, no interest, nothing like that. That program, to be able to not pay interest and just pay it back when you sell it or refinance it, is unreal for these type of programs. So it's amazing for you guys, for your borrowers.
Okay, so what's staying the same still? We're still using the very high income limits that we used for the first program. Not that it really means anything to you, but when we do a bond loan, we basically keep those, it's called area median income, or AMI. They're actually specific target limits that we actually get from our bond counsel, which comes from HUD and gets, we do all these, calculations and give us these numbers annually. But bond usually uses 100 to 115% AMI. This one we use 150% of the state 100% is how we get these numbers. And we actually just got our new numbers for 2023, and they're already posted, where before the minimum income per county, and some are much higher than this, but the minimum was like 118. It's now 128,000, and that's credit qualifying income. So that's what they can actually make in the majority of the counties. When you get into the Browards, the Miami-Dades, the Palm Beaches, it's much higher than the 128,000. But that's a lot of income to be able to buy these higher price houses. That's what we have in Florida now. We don't have those. I'm amazed when I see a house below 200. I'm amazed when I see something below 250. But again, with that much income, and if you don't have a lot of debt, you can buy a lot of house, right, Tim?
Yep, definitely.
Okay. And loan limits, like I said a couple of times already, bond programs have purchase price limits, which are much lower. With this, we do use the loan limits just like a lender would use for their normal loans. So again, very, very big numbers. What's FHA now? 500 something thousand, Tim?
Well, so I mean, it varies county. Lee County, where we're at, 472
Okay,
030. So
okay. So it's approaching that 500 number. And that's just for an FHA or, loan. So conventional is still the 726, I think it is.
yep,
So-
726 100, I believe.
Yeah, got to get that 100 in there, don't you, Tim? I don't know
Yeah.
why-
So I didn't do 99, 726 99 or something.
I don't understand why they do this. Just round it up, people. But you can't do that. And those limits, by the way, we're asked this all the time. You cannot exceed those limits. If you can't exceed that income limit, we're giving you the most we can give you. And you come in, and well, they're only $2,000 over the 128. They make 130. Can't you make an exception? No, we can't. And again, the lender's gonna actually figure all this out. Their underwriter's gonna double check them to make sure they're program eligible. And then we're gonna close the loan, and your people are gonna have a new house to live in. So again, there's kind of how these programs work.
Hey, Chip, and I just wanted to touch on like income on the credit underwriting side.
Okay.
I get calls from borrowers who are like, I can't qualify for this program because my income looks like this and it's under the limit. But as Tim said before, if they still have to qualify for the loan, so if someone has income that can't be considered because they don't have a history of that or whatever, then that just can't happen. So make sure that you're talking to your lender about the income, because they have to look at it, like he said, they have to have a 2-year history, likely to continue. And just because you're making under income limits now doesn't mean that we can use that income or whatever. So of course, just make sure you're talking to your lender. And don't let them like quit their job in between, while they're in the process and buy a car, stuff like that. So they
All
never
that-
do that,
all
do
that
they?
stuff on-
They never
All that
do.
stuff- all that stuff on the list that Tim gives you of things not to do, right, Tim?
Yep. Hey, listen, we tell them all the time, 5-6 times during the process, and someone will still do it. So don't worry, still happens. I did want to bring up a scenario we had this last week that I think it would be unique to people. Is we had a non-occupying co-borrower. So we had a person qualified for HomeTown Heroes, but they needed more income. And the non-occupying co-borrower already owned a home, but was not going to move into the subject property. Correct me if I'm wrong. We are able to use that person, correct? Because they're not signing the deed.
Go, Sandy.
Your non-occupying co-borrowers or co-signers can't obviously occupy the property.
Right.
So you can use their income to help them qualify, but you still have to include their income in the AUS. And we look at the AUS income for them to qualify. But yes, you can use a co-signer and they don't have to qualify. One of the borrowers that's occupying the property would, and they don't have to be a first-time home buyer. Just be careful that their income could push them over the income limit.
And on that note too, what was I going to say? I have no earthly idea. Train went off the tracks on that. I don't know. It'll come to me after I get off this call.
Or 3 in the morning, or 3 in the morning.
Probably. But no, we see a lot of non-occupying co-signers in this program. So again, thanks for bringing that up, Tim.
Yeah.
Next slide. And I already said this, if they don't qualify for HomeTown Heroes, we've got other options. Van Dyke has other options. We have other DPA products that still give you $10,000, 0%, 30 years. We've had those around for really decades, since we've been in business, about 43 years now. And I think Tim said this earlier, is don't just say, no, you don't qualify for this program. There's nothing out there for you. Let the lender look in the goodie chest and see if there's something they could come up with. Okay, next slide. So as what kind of properties can you finance with this? We get this all the time. And there it is, pretty much everything, single family detached homes, townhomes, multi-unit properties up to 4 units, as long as you're going to live in one of those, condos, manufactured housing on land. It's got to be real property. Manufactured housing does have some additional overlays that your lender's aware of, like it's got to be newer, like 1994, and some other requirements. But again, if you have that, if you selling that type of product, talk to Tim and his team, or whoever you're talking to, whatever lender, and make sure that they meet those manufactured housing guidelines.
Chip, I'd like to do a public a PSA, a public service announcement on this real quick.
Okay.
So Florida HomeTown Heroes the oldest you'll do is 1994 manufactured homes, correct?
Correct.
Okay, so realtors, listen, if you're out there right now selling manufactured housing from 76 to 94, okay, because that still qualifies, FHA, VA, conventional, be warned, okay? Insurance, if that person's getting a mortgage, is absolutely insane to basically unattainable. And we've had probably three buyers in the past few weeks, all manufactured homes between 76 and 94. And found one company. I see Sean's on the call. He had a company that would do it. It was $9,000
Jesus.
insurance. We had another one. I personally called 23 insurance companies in Florida, and I found one person that would write it, and it was like $7,800, and that's for a $200,000 manufactured home. It's going to blow your deal up. So 76 to 94 in Florida, be warned. Okay, if they need financing, insurance is absolutely insane.
And Tim, I wanted to add too, that we've gotten this from a few lenders, is if the appraisal comes in and it's older than 94, but it's been rehabilitated, it doesn't matter. If that year built is less, it's older than 94, we won't allow it in the program. So it doesn't matter if it's been rehabilitated to the moon and back. So just make sure you guys know that too. It's really based on the year it was built.
Short history lesson, 1994, what happened?
Andrew?
Oh my gosh, like what?
Hurricane Andrew.
Yeah, that was
Okay. So after 1994, actually beginning in 1994, they actually started building manufactured housing to wind codes. So basically, the closer you get to the water, the higher wind code the unit has to meet. And I forget, I used to actually be in that business as a lender back in my predatory lending days. We won't talk about that on this call, but but again, yeah, within like 1,500 feet, it's a much higher building standard. So the standards of the construction became much better after 1994 because of that. Okay,
right. And it's not to restrict somebody from purchasing an affordable product or affordable home. It's just that there's a risk of that borrower incurring post-closing costs, because the home wasn't built to meet those federal standards from 1994 and on. So just keep that in mind.
Let's go to the next slide.
We beat that one to death.
I think so. And we're almost at the end of this thing, by the way, folks.
Yeah,
Okay.
I mean, we carved out an hour. You got 6 minutes, so we're doing good.
Cool. Okay, once you use our program, it's one and done. So if they've used this program in the past, received DPA to buy their first home, they're not eligible for any other programs that we offer, including HomeTown Heroes. That's our job. This program is to serve first-time home buyers. Hopefully they got in that house, bought it at a good time, sold it at a good profit, and bought their next house, whether it's there forever or not. But we're out of the picture now. Let's help the next first-time home buyer. So that's what we do, right, Sandy?
Correct.
Next slide. Hey, I told you we were almost done. So those are the things. So you see, really, that's why I say the program hasn't changed. It's been enhanced. It's been easier. It's out there to help a lot more people with more money. And if someone's going to ask this question or thinking this question going, well, let's see, you had 100 occupations, Chip and Sandy. It took you a year to spend that money, or your lenders to spend that money. How long do you think this will last? Sandy, what's your guess?
I mean, if I were to guess, I would probably say five or 6 months, but you're the math person, so.
Well, since I know that lenders, and I don't know how many loans Tim already has ready to load come July 2nd.
Not enough, Chip. We need more.
But yeah, they've, like I said, ever since the Live Local Act came out, we started talking about the program. July 3rd will be a busy day for us. Hopefully the system doesn't blow up. The e-housing assures me it won't, but 4 to 5 months, that's what I give it. Because again, and Tim kind of jokingly said earlier, everyone's a hero. Almost, almost. You're a first-time home buyer, you're credit worthy, you can find a house, right, Tim? That's also key.
Hey, listen, that's the realtor's job on here.
There you go.
They got to find them a house.
I like that. Turned it back.
Yeah, and if I can, Chip, are you good?
Yeah, we don't have anywhere to go.
Okay, I just want to make sure I let everyone know just a couple of things and we'll get this thing wrapped up. You know, you were invited here by a Van Dyke Mortgage Loan Officer. We want to be here to serve you and your clients. One thing we can do to help y'all out is when you have these buyers and you make that offer, let us call the listing agent for you. Let us tell them how great the buyer is, how great we'll do, how great the process will be. Let us help you get that offer accepted, because Chip just said, you know, we got to get them under contract, and everyone on this call is an active realtor knows, like, getting a buyer under contract is tough. So we want to give y'all a lot of help on that. We'll call the listing agent for you. And again, it'll help a lot, because a lot of times your Van Dyke Mortgage Loan Officer may know that other agent as well, or they know another Van Dyke Loan Officer or something like that. So just keep that in mind. And Chip, do you have anything else you want to throw in?
I think we pretty much covered it. You know, if there's going to be any difficulty in qualifying someone, it's going to be self-employed. I think we hit on that pretty good, but basically we're looking for some kind of third-party verification of those hours worked. And the fact that it is a Florida-based business, and we could track that down, you know, in some resource. But that keeps coming up. It came up in an MBA panel I was on yesterday down in Orlando. And I said to them, well, go after the other 98% of the people that, you know, you don't have to go through those extra gyrations for. Go down to Foot Locker. Guess what? The person in that black and white striped shirt selling sneakers, they're a hero too. So again, you should have an unlimited number of prospects to work with, where you don't have to get bogged down working with someone possibly that might be a little more difficult to get approved. But by the same token, a deal is a deal, a sell is a sell. You're going to do what you need to do to, you know, to help the folks you work with, and hopefully at the same time make a living. So that's really about all I have. What about you, Sandy?
I just wanted to say again that only one buyer has to qualify as the hero. So, you know, just kind of keep that in mind, that you don't have to have everyone satisfy the 35 hours and the employment requirement. So it's just one, because we get asked about that a lot. I just wanted to remind you guys. And
I remembered, yeah. Sandy, the cosigner. Okay, I told you to come back to me eventually.
What was the question?
When we were talking about the cosigners and what they can and can't do.
Okay.
You talked about, you don't have to be first-time home buyers. The other thing was not only providing cosigner, all they sign in this transaction are the notes. They definitely cannot be on title. They don't sign mortgages. They sign the first and second notes, and that's the only documents they sign in one of these closings. So, you know, don't make. I've got one lender that they were letting them go on title, and they have a mess. So and again, Tim and his team will take care of all that stuff. But just so you know, if they're saying, I'm going to give you $50,000, son, but you know, I want a piece of the action in case, you know, you don't pay. I'm going to take it and sell it. I'm going to do all these things. No, you won't. You're going to guarantee the debt, Dad. That's all you get to do. So just trying to clarify that a little bit more. It's irrelevant, but since I remember before I got off, I had to get it out.
No, that's a good point though, because that's that does come up a lot.
Yep. And Tim, so we'll turn it back over to you to wrap it up.
Yeah, appreciate it. And Kathy, we'll email you over the income limits too. A lot of them are online. It depends on the loan program and where you're located. So we'll shoot you over a message on that. But hey guys, appreciate y'all being here. It means a lot. Hope y'all found value. And Chip and Sandy, thank you both. I'm telling you, Florida Housing, you guys, they respond to our questions. I mean, Chip gave me his cell phone number the other day. I called, you know, it's on his email. It's crazy. So thank you very much. Appreciate it. Also, shout out to Nisha. See you. But listen, you guys, Van Dyke Mortgage, again, a loan officer invited you here. You guys got questions, borrowers, anything you need help financing wise, reach out to them. You know, with myself, great. But reach out to any of us and we're happy to help. Jeff, you got a question, man? Hold on one second. I gotta.
Nope, that's applauding. Great job. Yeah, that was hand clapping, applauding to Chip and Sandy, and special thanks to you, Tim, for helping out and putting this together.
Yeah, man. Hey, FYI, diehard Florida Gator fan here. Jeff Starnes played for LSU baseball. He's a Van Dyke Mortgage Loan Officer. You're going down Friday, Saturday, and Sunday, buddy. So I'm sorry. All right. Hey, you guys, thanks again for being here. We appreciate you. And this will be recorded and we'll email it out to you all as well. Okay. So thank you very much, everybody.
Thank you.
Later.
Bye-bye.